Most people think saving money in the bank automatically means becoming more financially secure over time. But inflation changes the value of money in ways that are easy to overlook. Because the number in your account stays the same, while the purchasing power behind it slowly shrinks. If inflation remains elevated for years, everyday essentials like housing, food, transportation, healthcare, and energy could become dramatically more expensive, making today's savings by far less in the future. Today we will talk about if inflation keeps going, your savings will be worth nothing by 2030, so before we get started, make sure to hit that like button, also subscribe to my channel. 10. Most people think saving money automatically makes them safer. For most of modern history, saving money has been treated as one of the most responsible financial habits possible. People are taught to work hard, avoid unnecessary spending, and slowly build savings accounts for security and stability. And while having savings absolutely matters for emergencies and financial resilience, there is a growing problem many people underestimate. The value of money itself changes over time. Your bank balance may stay the same, or even increase slightly, but if the purchasing power of that money keeps falling, your real wealth may actually be shrinking quietly in the background. This is the hidden danger inflation creates over long periods. 9. Inflation is like a silent tax on your money. Inflation simply means that goods and services become more expensive over time. Food, housing, transportation, healthcare, insurance, and daily necessities gradually cost more than they did years earlier. This means each dollar buys less in the future than it buys today. Unlike normal taxes, inflation feels less visible because money is not directly removed from your account. Instead, purchasing power slowly erodes year after year. The danger is that many people focus only on how much money they have numerically without considering how much real-world value that money actually represents. 8. Savings accounts often fail to keep up. One major problem is that traditional savings accounts frequently pay interest rates far below inflation rates during high inflation periods. If inflation rises at 5 or 6% annually, while savings earn only 1 or 2%, the real value of savings declines every year despite earning interest. Many people believe they are protecting wealth simply by holding cash in banks. But in inflationary environments, idle cash can gradually lose significant purchasing power over long periods. The numbers may rise slowly, but the buying power behind those numbers shrinks much faster. 7. Compounding works against savers during inflation. Most people understand how compounding can grow investments over time. But inflation compounds too. Small annual increases in prices eventually create dramatic long-term effects. A product costing one amount today may cost significantly more a decade later, because inflation builds on itself continuously. This means that even moderate inflation rates can drastically reduce the future value of cash savings over time. The longer money sits without meaningful growth, the more vulnerable it becomes to this compounding loss of purchasing power. 6. Governments and central banks influence inflation deeply. Inflation does not happen randomly. Interest rates, money supply expansion, government spending, global supply chains, energy prices, and economic policies all influence inflationary pressure. During economic crises, governments and central banks sometimes inject large amounts of liquidity into economies to stabilize markets and support growth. While these actions may help short-term economic activity, they can also contribute to rising inflation if too much money enters the system relative to available goods and services. Modern economies increasingly rely on active monetary intervention, which makes inflation management far more complex than many people realize. 5. Wage growth rarely fully solves the problem. Some people assume rising wages automatically protect against inflation, but this is not always true. In many cases, living costs rise faster than income growth, especially for housing, healthcare, education, and insurance. Even workers receiving raises may feel financially stuck because larger portions of income are absorbed by rising expenses. This creates the frustrating feeling of earning more money while experiencing little real improvement in financial stability or purchasing power. 4. Asset owners often benefit more than cash savers. One major reason inflation widens wealth gaps is because assets often behave differently than cash during inflationary periods. Real estate, stocks, businesses, commodities, and productive assets may rise in value over time alongside or faster than inflation. Cash, on the other hand, remains fixed, unless invested. Wealthy individuals often hold significant portions of wealth in appreciating assets rather than idle savings, because assets have greater potential to preserve or increase real purchasing power over long periods. 3. Retirement planning becomes much harder during inflation. Inflation creates enormous pressure on retirement planning because retirement itself depends heavily on future purchasing power. A retirement savings target that appears large today may provide far less security decades later if inflation remains elevated for long periods. Healthcare, housing, food, and living expenses may consume much larger portions of retirement income than originally expected. This forces many people to either save far more aggressively, invest differently, or continue working longer than planned. 2. The real danger is slow financial erosion. Hyperinflation scenarios capture public attention dramatically, but the more common danger is slow erosion over many years. Small yearly losses in purchasing power may seem manageable individually, but over decades they can completely reshape financial outcomes. People may technically accumulate money while simultaneously becoming poorer in real terms. This gradual decline often happens quietly enough that many households do not fully recognize the long-term impact until major financial goals become increasingly difficult to reach. 1. The real threat of inflation. Cash alone cannot protect long-term wealth. The deeper truth about inflation is not necessarily that savings will literally become worthless overnight. It is that relying entirely on idle cash in a constantly inflating economy creates long-term financial vulnerability. Because the truth is simple. When prices rise faster than savings growth for many years, purchasing power steadily disappears, even if account balances increase numerically. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.